sequence, steps, sequence or steps, sequence or steps, steps for the application of GLoBE rules, application of GLoBE rules. Number one. Step number one. First of all, you need to find out which all groups are in scope. Groups in scope. That is M&E groups. M&E groups in scope. M&E groups in scope. M&E groups in scope, as well as the location of each entity within that group. Fine. So supposing you have country A, B, C, D and E. M&E group, for example, Google operates in, or Walmart operates in country A, B, C, D, E. And Walmart, the annual revenue is 750 million euros, more than that. So Walmart is in the scope of this GLoBE 2, pillar 2 rules. Yes. So now you will find out that what is the groups in scope. So Walmart is in scope. Location of each entity within that group. Location of each entity within that group. Why? Because you should remember that the objective is that every M&E, the group as such, M&E, should pay 15% tax in every country in which they operate. Right? This is the objective. So supposing Walmart has one entity. It has, okay, so this is one entity. In country B it has two entities, two subsidiaries. In country C it has again one entity. In country E again two entities. Country D three entities. So you find that this Walmart group has got number of entities. 1, 2, 2 and then 3. Location of each entity of the M&E group in every jurisdiction. Right? This would be done as a part of your one. Fine. And GLoBE model rules, they have elaborate provisions. Chapter number 1. This will give the rules how do you decide on the scope or the location. Constituent entities CE. Fine. This is the step number. This is the first step. Groups in scope and the groups in scope and the location of every, plus the location of each entity. Location of each entity within the group. Each entity, constituent entity. Okay. Number two. Taxes paid. Just give me a moment. Okay. Second is income. Taxes paid would be third step. Second is income. That income is known as GLoBE income. Calculation of GLoBE income. And this is where all those complications arise. What to calculate, how to calculate, what accounting standards have to be followed, what exclusions have to be followed. All these things, they would be as a part of GLoBE income. So I am simply writing GLoBE income calculation. It's not easy, it's very difficult. Fine. But then GLoBE model rules, chapter number, chapter 3 of the GLoBE model rules, they give you detailed provisions as to the calculation of the GLoBE income. Fine. And I have shared this document also with you, GLoBE model rules. Okay. There would be certain exclusions and so on and so forth. Number 2. Number 3. Now remember that diagram. What was the diagram? The diagram was this 15% is the minimum rate, the globe proposed minimum taxation rate. But then 9% is the CIT that has already been paid. So this 6% was the top tax. So this tax that has already been paid, this would be calculated as a part of your third taxes paid, and those taxes are known as covered taxes. Covered taxes. Again very elaborate, very complicated proposals, and they would be covered in chapter number 4. Yes, chapter number 4 of the GLoBE proposals. Example to give you, the credits, foreign tax credits, when they would be given to you, when the taxpayer would receive the credit, the covered taxes would be reduced. When the tax credits would be again given back, they would be increased. So there are elaborate provisions. That is why I am saying that this is just the sequence of steps and the basic mechanics. And these are the rules, especially the calculation of the income and the calculation of the taxes, which makes these rules so complicated and so intricate. Groups in scope, GLoBE income, covered taxes. Number 4. Once you have calculated the GLoBE income, supposing you survive till now, you survive till this stage, then you reach stage number 4. Stage number 4 is the calculation of the top of tax. Calculation of top of tax. See this. Calculation of top of tax. This begins by calculation of a ratio which is known as jurisdictional ETR. Jurisdictional, that is country based, country specific, jurisdictional, country specific. Jurisdictional ETR. ETR is effective tax rate. ETR. Jurisdictional ETR is equal to effective tax is what? Effective tax is covered taxes that we have already calculated in step number 3. Covered taxes. I am writing step number 3. Step number 3 upon the GLoBE income. Upon the GLoBE income. GLoBE income that we have calculated in step number 2. So if you divide the covered taxes by the GLoBE income, taxes by income, that will give you the effective tax rate. And because that is specific for a particular country, that is why it is known as jurisdictional ETR. And mind you, here, you know what? Here, when you are talking about covered taxes and when you are talking about GLoBE income, supposing you have country A and you have country B. So supposing we have a M&E group, right? So ACO is the parent company. Okay. ACO is the parent company. ACO 1 is the subsidiary. ACO 2 is the second subsidiary. ACO, right? ACO parent company, ACO 1 is the subsidiary, ACO 2 is subsidiary. These two subsidiaries are located in country B. And not only this, not only subsidiaries, even permanent establishment. So ACO can have a permanent establishment located in country B like this. Supposing this is ACO, it might even have a P. So PE, permanent establishment, for the purposes of GLoBE rule, that is taken as a separate constituent entity. We know that PE is not a distinct legal entity, but then GLoBE proposals, they propose that for the purposes of GLoBE rules calculation, PE would be considered as a separate entity, right? So when we are talking about the GLoBE income and cover taxes, we have calculated. So suppose you have ACO 1, ACO 2, forget about PE. So you have calculated, and you are talking about ETR, for example, ETR B, country B. So in the numerator, covered taxes, the taxes paid by ACO 1 plus the taxes paid by ACO 2, they will be added. Because remember, just keep this in mind, the 15% tax rate is on the country basis B, and we are talking specifically about country B, so that is why it would be at the level of the country. So covered taxes include the taxes paid by ACO 1 plus taxes paid by ACO 2. Similarly, in the denominator, GLoBE income would be calculated as per this step number 2, but then this income would be income of ACO 1 plus ACO 2. Is this point clear? That is why it is known as jurisdictional ETR, that is the effective tax rate paid by the MNE group in country B, in jurisdiction B. Yes or no? Ali, Altaf, Charan, Deepak, Jolly, Krigan, Neha and Shrikant.
So what about PE?
PE also?
PE taxability.
Yes, PE. That PE income attribution of profits to permanent establishment, and then the rules, PE definition, etc. All those definitions, all those rules pertaining to PEs, they are also present in the GLoBE model rules. There is a chapter on PE. That will also be combined here. Taxes and income. Right?
One more thing, there are, you see, always the taxation regulation relating to depreciation and amortization, and a different, you see, amount is calculated and then percentage is applied. So percentage will be in terms of accounting income or taxable income.
Again, these are very nitty-gritties. For this, you will have to do the research and R&D on your own. I have pointed out the relevant documents to you, and this you will have to do on your own. This is much beyond the scope of this class. This is not required for the purpose of ADIT, because even the tax administration, they don't know, they haven't done this calculation, and frankly speaking, even I haven't done a detailed research on the GLoBE rules. I started reading the GLoBE model rules. I have read them, even the commentary, to a very large extent, but then when I saw what is happening, so the future, unless and until it gets implemented, I have taken a break as far as the GLoBE rules are concerned. I'm monitoring the development. I know all the concepts, and when they would be implemented, then I'll finally start. Then I'll finally complete my understanding. Plus, number 1, number 2, it is very difficult. It is almost next to impossible for a single person to take care of the entire GLoBE proposals on his own. Why? Because you will find that there are number of specialized disciplines being involved. For example, calculation of GLoBE income and calculation of covered taxes, you need to have that specialized knowledge of accounts, standards, in order to take care of this. Simply, and for other purposes, covered taxes, rules, law, they are specialized legal provisions. So somebody who is taking care of this will not be able to take care of this, and somebody who is taking care of this will not be able to take care of this. So single person. Every answer to your question is in the rules, is in the commentary. Please do the homework. Right?
Right, after the exam.
Yes. And tell me if you are able to do that. Take it as a challenge. If it were so easy, don't think that I am challenging you, but if it were so easy, this much of brouhaha or this much of clamor would not have happened. But can be attempted. Please do that. Fine. Okay. Jurisdictional ETR done. Covered taxes, GLoBE income done. Second step, after you have calculated the jurisdictional ETR, okay, GLoBE income. Then you do what? So now you have ETR. Supposing this ETR comes out as what? Supposing this ETRB, this would be in terms of percentage, it would be a fraction. Supposing this ETRB comes out as 0.1, that is 10%. Right? So ETRB is 10%. In the next stage of calculation, what you will do? You will calculate top of tax percentage or rate for country B. Now can you tell me, if the ETR is 10%, what will be the top up tax rate for country B? Anyone? Ali, Altaf, Charan, Deepak, Jolly, Krigan, Neha and Shrikant. What would be the top up tax percentage?
5.
Ali, Charan, Deepak, Jolly, Krigan, Neha, Shrikant.
Yes, to close the 15%.
Yes,
5%.
simple. This is 10. Covered taxes are the taxes which have already been paid by all the MNEs in country B. Right? Covered taxes are the taxes country A and country B. So you have ACO 1, ACO 2, and this is ACO. So covered taxes are the taxes that have been paid by the group, ACO group in country B. That is 10%. So the remaining tax which is required is 5%. So therefore, top up tax percentage will be equal to 5%. In terms of equation, it is equal to global minimum tax rate, that is 15%, minus ETR, minus ETRB. So GMT we know is 15%, ETR is 10%, so ultimately you get 5%. And this is what I meant. If your ETR would have been 0.15, then top up tax percentage would be equal to 0. Calculation ends, finishes. So 0.15 or more than 0.15, job is done. No need for this excessive or elaborate calculation. Right? But okay, let us move further. So now top up tax percentage equal to GMT 15% minus ETR, that is equal to 5%. Okay. Now let us move further. In the subsequent stage, we calculate jurisdictional excess profits. So jurisdictional excess profits. Jurisdictional excess profits. Now, how do you calculate jurisdictional excess profits? Jurisdictional excess profit is equal to GLoBE income that you have calculated into minus, very important, minus substance based income exclusions, minus substance based income exclusions. Substance based income exclusion. Substance, requirement of substance, action plan item number 5, transparency and substance. Jurisdictional excess profit is equal to GLoBE income minus substance based income exclusion. How do you calculate whether the MNE group ACO has substance in country B or not? So GLoBE proposals say that we'll calculate the substance of this MNE group in country B on the basis of the tangible assets that they have in country B, and on the basis of payroll, salaries, etc., employee expense, tangible assets and payroll. So return on tangible assets and expenditure on payroll, that is return on payroll. On the basis of these two factors, substance based income exclusions will be calculated and they will be deducted from the GLoBE income to arrive at the jurisdictional excess profit. Again, calculation, etc. provided in the modules and the commentary. But then you are making some certain exclusions. What is the rationale? The rationale is when you have tangible assets and when you have payroll, that is you have real employees working in ACO 1, ACO 2 in these companies in B, then there are very less chances that the company ACO 1, ACO 2 and the group would be indulging in base erosion and profit shifting. Base erosion and profit shifting is when you don't have anything. Letterbox companies, shell companies and everything flies off. So when you have tangible assets, building, machines, etc., tangible assets and people, so that is why due credit is being given for these two assets, right? So GLoBE income minus substance based income exclusion, this is known as jurisdictional excess profit. Fine. So let us jurisdictional excess profit for B. Fine. So we have 4. Let us make this top up tax rate. This is, say for example, 5. And jurisdictional excess profit, this is, say for example, 6. Fine. In the last stage, you calculate jurisdictional top up tax, not the rate, because rate we know, top up tax rate we know for 5%. We'll calculate jurisdictional top up tax, that is the amount. Jurisdictional top up tax, and that will be equal to top up tax rate for the B, for the jurisdiction, multiplied by the jurisdictional excess profit, that is 5 into 6. So meaning to say that if the jurisdictional top up tax rate in our case is 5% and the jurisdictional excess profit was, say for example, $1 million, 1 million euros, then the total amount of top up tax that may be collected by jurisdiction B due to the application of GLoBE rules, that will be equal to 5% of 1 million, that is 0.05 million. Is this point clear? So this is equal to jurisdictional top up tax rate into the excess profit. This will be equal to the jurisdictional top up tax that can be collected by country B under the application of GLoBE rules.